gasoline prices continue to decline across the nation, falling for a fifth consecutive week. The national gas price average currently stands at $3.26 a gallon. And for more in the energy sector, let's bring in Bill Baruch, Blue Line Futures President. And Bill, always good to see you here. We can get into the nitty-gritty weeds of the futures market in a little bit. But first, your comment on these declining gas prices, which we kind of saw up until now and also coming off the election, but they're here and they are resonating in the public's mind.
You're right. I mean, there's been a bit more tepid demand than the market was really prepared for. We've seen this price action come down in the $2 in the gasoline futures and retest that level when it was Omicron breaking in November, Thanksgiving of last year. So this is a pretty big level. I think there's a lot of support down here, and we're actually getting excited at this. But if you look at jet fuel inventory levels, sort of in line with historical averages, that's something relative to all the travel you're seeing, the numbers there, it's showing more alludes to tepid demand. Crack spreads have come in. And then, also, I think overall, there's a lot of sentiment taking this further as some liquidation comes into the market when it hits some levels.
So, Bill, I guess it sounds like this is presenting a pretty good buying opportunity, at least from your perspective.
Yeah, we've looked at it as a buying opportunity. I was joking around in interviews I've done in recent weeks and months that I've probably done as little in the energy space as I have done in the last, probably my whole career. I have sort of just being patient, and patience was really going to bring opportunity. And now we're seeing crude oil WTI contract get to $70. There's a lot of support down there on a technical basis, but also on a psychological basis. You don't want to see it break and close below 70, but so futures portfolios that we're trading very actively. I'm getting long in some call spreads in the February contract. 77.5, $81 call spreads. They're under $1. I think there's a pretty good upside there on a good rebound. We're also buying Oxy in securities portfolios. I think there's really tremendous value. It's a great trading vehicle we've used for much of the year.
I wanted to ask you, but there had been a bit of a discrepancy between XLE, that's the S&P 500 energy sector, the way that was trading and the way crude oil was trading. And not that they're always supposed to be in lockstep, but energy stocks finally came down a bit to meet crude oil prices, which has declined. And then taking your thesis that energy prices, at least WTI above $70, is constructively bullish. Anything besides Oxy? Are you liking the sector as a whole? What other energy stocks would you be thinking about buying here?
Yeah, we're very bullish on the sector as a whole. We've had between 15 and 20% exposure in the energy stocks in those portfolios this year. We dialed back in a couple recent weeks. Kind of fearful on the crack spreads. So Phillips 66 is one that we had stepped out of. Kind of rolling back in. I think a little more of a high beta play in Oxy here. But historical averages, if you look at the relative. XLE relative to crude oil, I mean, it was beaten down over the past really 18 months. And this is a rebound back towards the more historical mean. So I think this is something to keep in mind. Overall, broadly, crude oil is an area, $50 to $70. I like to just broadly think as, vicious volatility can happen in between it, but there's good bull markets while out above 70, 80 area that can anchor, but vicious, volatility between that and then bear markets below that $50 benchmark. So I think right now, if we hold 70, I remain very upbeat, but again, it's a very underinvested space, and these companies, they have tremendous free cash flow yields, like Oxy, 12, 13%. I mean, Exxon, 10%, Pioneer right around, I think 10%. And then, a lot of these companies, the cash flow is terrific. They've gotten themselves and their balance sheets into a really great spot here the foreseeable future, given especially an underinvested industry. I remain very bullish.
Bill, what about the biggest drivers of the price action that we've seen recently? Because I think a lot of traders heading into the month of December thought it was going to be a tough month when it comes to oil because of the Russian sanctions on Russian oil, that were going into effect this month. But it simply looks like demand seems to be the number one driving factor. Is that true?
Yeah, I think the demand is, like I said, a little weaker than one would expect. And you're seeing that with some of the crack spread movement, a bunch of different indicators that are out there. But I think broadly speaking, the headwind has been the SPR release. And I think that's going to become a more bullish factor as you look into next year. The other factor, too, I think, again, this is a market, the underlying crude oil prices, these global growth fears that really became very relevant last week. And they've been relevant for weeks prior as well. But I think last week, really kind of started to get that people scared. It just kind of a lot of the headlines. So I think a lot of liquidation, really took place. But the other side of that is the China reopening. And it's not something that's going to happen all at once. Something that's going to happen sort of slowly, marginally through the first quarter of next year. And I think there's a lot of longs in the space that were sort of leaning on this China reopening. And the fact that we couldn't get out above $83 technical resistance, I think just led to a lot of liquidation through last week. And then if you were patient enough and you weren't caught up in that windfall of price action, then opportunity is here for you.
All right, real quick here. SPR refilling the Strategic Petroleum Reserve at $70 per barrel. Is that a floor? Is that something big? At least in my mind, I haven't heard of a floor in terms of U.S. crude prices in some time. What does this mean to you?
We haven't heard a lot of jawboning in recent sessions, but you go back a couple of weeks, OPEC Plus was clearly looking at $70 in WTI as an area of to lean against and jawbone, $80 in Brent, roughly speaking, as an area that we would hear some jargon coming from. And if we don't see an uptick in global growth, we're likely to see potentially more production withheld in the coming meetings. I think that's going to be a bullish factor. There's a bit of keep away that I think that was being played because the White House said they were looking for $70 or below $70 to start replenishing that SPR. So I think a good response off the $70 level here today. There's definitely, I think, a great trade, but the incoming news, I mean, CPI tomorrow is going to be a big one. Yeah. And the Fed and the narrative that we get from the Fed and the rate hikes to come here and through what would be a rate hike on Wednesday, as well as coming in February. I think it's going to just be a good pulse on the risk environment. You're going to need to keep a pulse on the risk environment in order to really kind of trade this market and navigate. But for now, it's a really good response off $70. I think there's room to run. But again, it's going to be a very volatile week.
All right, got to leave it there. Bill Baruch, thank you as always.